Welcome back to this course on infrastructure finance. This is lecture 22. In this lecture we will again continue our discussion on risk management, and towards the end of this lecture we will try to focus on the next set of risk we talked about, which is basically the market risk. But before we actually do that, let us try and discuss the questions that we actually had at the end of the previous lecture. In fact, we had one question at the end of the previous lecture, but what I realized is we did not discuss a question that we actually had at the end of lecture 20. Lecture 20 we actually had two questions, but we ended up discussing only one of them. So, I thought we will spend some time discussing the second question that we had at the end of lecture 31st before discussing the question that we had at the end of lecture 31. Okay. So, the question that I wanted to first discuss is, are there projects that do not have any offtake contracts, and how are the risks managed in these projects? See, ultimately you will have to realize that so many of the contracts that we talked about is essentially a way of managing risk. And so, if if we actually have to run a project in a very a satisfactory manner, the risks have to be allocated to the people who are best able to manage it, and unfortunately not all of the risks can be mitigated, and in some cases as we will see we may not even actually have an offtake contract. As we have seen earlier, an offtake contract is one of the important mitigating mechanisms of revenue risk. So, how do we actually manage projects that do not have any offtake contracts? But to answer the first question, that are there projects that do not have any offtake contracts? Yes, there are projects that do not have any offtake contracts. Specifically, I can give you an example in the power sector. In power sector, that too in the generation segment, if you really look at, we can classify private power generation plants into broadly three categories. So, the first category you have what is called as your TPPs, which is your tolling power plants, and then you have your IPPs, which is your independent power plants, and then you have your MPPs, which is your merchant power plants. Right. So, TPPs are those power plants where it is actually operated in a way where there is very limited risk on the project company. Essentially the operations of the plant is decided by, let us say, a fuel supplier, and whenever the plant is being operated, the project company gets all the operating expenses plus a return on the investment. Okay. So, essentially if you really look at it, the fuel supplier decides when to actually operate the plant, and it is a facility that is available for the fuel supplier because the fuel supplier decides to either sell fuel at the open market, or he decides to generate power using the surplus fuel that he might have produced. So, when to actually operate the plant and when not to operate it depends on so many factors, depends on the fuel production, depends on the market prices of the fuel, and so on and so forth. But essentially the tolling power plants are operated based on the needs and the demands of, let us say, the fuel supplier. So, if the plant is not being operated, they will still actually be compensated by means of some kind of a charge, and if the plant is being operated, it will also include the energy charge. So, remember in the previous lecture we talked about the availability charge and the energy charge. So, in the case of a tolling power plant, even if the plant is not being operated, the availability charge will continue to be paid to the project company, and whenever the plant is being operated, depending on how do we actually see the fuel cost, sometimes if the fuel cost is actually borne by the fuel supplier, then in the case we are actually trying to give a facility of power generation to the fuel supplier. So, therefore, it becomes like paying a toll for using the facility, like a toll road. When we try and use a toll road, we pay a toll to use the facility. Similarly, in this case, for trying to use the power plant, we actually pay a charge. So, the kind of risk that exists in a tolling power plant is going to be very minimal because there is virtually no demand risk, because the power plant will be operated based on the needs of the fuel supplier, and the tariff and the charges will be calculated in such a way that it will meet the debt interest on debt as well as your return on equity. And if you really look at independent power producers actually have an offtake agreement. In this case, the offtake agreement is with the power consumer. So, it could be a electricity distribution company, or it could be any large industrial house, and so on and so forth. So, we really have a power purchase agreement, and the power purchase agreement mitigates the revenue risk in the case of IPPs. See, the power purchase agreement will specify what will be the tariff and how much of power will be consumed by the purchaser and so on. And then we have the merchant power plants. So, merchant power plants are those plants where there is no offtake contract, and it is completely dependent on the demand and supply of electricity in the marketplace. So, the merchant power plants might not be operated at all times, it might be operated only when the demand is very high, and they are actually called as your peak load plants. So, to an extent they do not really have an offtake contract. When the demand is more than the supply, merchant power plants will start generating power and supply in the market. But when the supply is able to meet the demand, when the capacity is able to meet the demand, then the merchant power plants will not operate. So, there is no offtake contract, it is entirely exposed to the market risk. So, as we actually see these broad categories of power plants, we find that as we move from TPPs to MPPs, the level of risk increases, right. So, the level of risk increases, and the level of risk is high in the case of MPPs, and the level of risk is low in the case of TPPs. Okay. Now, what risk we are talking about? So, we are talking about the business risk that exists in the project company as we move from TPPs to IPPs. Now, when the business risk is higher, can we actually compensate it by reducing the risk in some other fashion? Okay. So, this is one aspect of risk management. Let us say, for example, a project company can be broadly classified to be having two types of risk. One is your business risk, the other is your finance risk, right. So, when we actually have a low business risk, that means we have very well established risk management mechanisms. We actually have offtake contracts, we have supply contract, we have all of the other contracts in place. So, that means the business risk is being well mitigated. When the business risk is low, then we try and fund the project which will actually have a higher degree of financial risk. Now, what will have a higher degree of financial risk? When you actually try and have a capital structure that has a higher degree of debt, then the financial structure is supposed to be a little bit more riskier. Why? Simply because if the project company is not able to meet the debt obligations, then it will actually approach bankruptcy. So, therefore, the risk is higher when we have a higher level of debt. So, to compensate, for example, if you are able to, if you are actually having a low business risk, then we can actually have a financial risk structure, we can actually have a capital structure which is having a higher degree of financial risk, so that we are able to produce power in a competitive basis, right. Remember, if you are talking about higher degree of financial risk, so that means we are talking about higher level of debt, and when you have a higher level of debt, so we are able to actually produce power at competitive rates. Higher degree of debt results in a very positive, results in a positive impact on tariffs. So, therefore, a positive finance risk will be able to compensate for the I would not say compensate, but it will probably counteract against the low the business risk that prevails in the project. Remember, when you are talking about a low business risk, we are actually going to have a lot of contracts, and whenever we are trying to have all these contracts and agreements, it is essentially going to result in increase in cost, and this increase in cost to a certain extent will be compensated by lower cost of capital if we have a higher degree of debt. Okay. Now, look at the other situation. the other situation is the business risk is very high, right, the business risk is very high, and so therefore, in this case if you want to really make the project company having an acceptable level of risk, then we should not really have a capital structure which has a higher degree of financial risk, but we should have a structure which has a lower degree of financial risk, right. So, a higher risk on the business front is to a certain extent compensated with a lower degree of risk in the financial structure. Okay. So, how do we actually have a lower degree of financial risk? We will have a lower degree of financial risk by having lesser leverage in the capital structure, that is fund the project with lower level of debt. Okay. So, this is the example that I am talking about, right. So, when we actually have projects which has a higher level of business risk such as your merchant power plants, then the capital structure of these projects will have a higher level of equity as compared to projects such as IPPs which will have a higher level of debt. Okay. So, we manage the risk in these projects by using a capital structure that carries a lower level of financial risk. Okay, now we will get to the next question. The second question that we had at the question that we had at the end of lecture 31 is we talked about various methods of contracting. So, the question is are there any other ways in which we can manage project specific risk? Can you give some examples? Okay. So, apart from using contracts and agreements, how do we actually manage project specific risk? So, is there any examples? So, the one word answer that I can give you is insurance. Okay. So, when we actually have a contract, the contract is essentially trying to manage certain level of risk to different parties, but there are several risks that cannot be managed, which probably we cannot find a counterparty for which we can write a contract. So, those risks will have to be essentially mitigated by using insurance. Okay. So, insurance is a very important aspect in the case of project finance or infrastructure finance. This is an aspect that concerns both the project sponsors and the lenders equally. It is not it's concerned only lenders, but project sponsors also are equally concerned and ensure that there is a well thought through insurance package for the entire project. Lenders view insurance as an integral and a key element of the overall security package. So, remember we talked about a financial closure, and the time of financial closure lenders will ensure that there is adequate risk management mechanism in place, and more importantly they will also look at what is the security that they have for their investment. Okay. Now, a very important component of the security package for the project is the kind of insurance that the project will have to take. Okay. Because the insurance package will ensure that in the event of any major casualty or disaster, the lenders are paid their investment, the lenders get their investment back. Okay. Insurance also ensures that the project is restored to operability should an accident or force majeure cause contractual failure. So, for example, there is an accident, it could be a fire, it could be an earthquake, it could be any other natural disaster. So, because of that the plant let us say undergoes damages, and because the plant has undergone damages it is not in a position to let us say generate power. And if the project company has actually signed a contract with the power producer, and this damage will this damage will result in a fact that they will not be able to honor the commitment that they have indicated in the power purchase agreement. So, this can lead to what is called as a contractual failure. So, therefore, the project company might have to compensate the power purchase agreement and so on. But if we actually have an insurance, then such events of contractual failure will be compensated by the insurance claims and not by the project company, because the project company might itself not have the wherewithal to actually compensate the contractual failures, but insurance company, because of being a larger entity, because of the fact that it is able to manage risk a lot more effectively, will be able to pay the compensation or other damages that needs to be paid in the case of such contractual failures. So, how do we actually create an effective insurance package? So, I think most of us know about insurance in general. You know, for example, we know about life insurance. There are several life insurance companies that are operating in India. So, if you want to actually take a life insurance, we actually approach any of these companies directly in most cases and then take an insurance depending on what we need from the insurance. In addition, we are also familiar with other types of insurance. For example, we are familiar with health insurance and we are familiar with general insurance, which we use to insure our vehicles, our houses, you know, our property and so on and so forth. Right. So, in all these cases the risks are commonly known and it's a direct interaction between the insured and the insurance company. Okay. So, there is no intermediary involved, okay. And the products are also commonly understood and there is not so much of complexity in insuring some of those things that I just talked about. But if you are talking about a project finance entity, the insurance is not so simple, it is a lot more complex and it is actually highly customized. You know, for example, with the normal insurance policies that we are aware of, it is not customized to a single individual. There are so many products that are available in the market. So, we go ahead and buy the product that is suitable for our need, but in the case of this kinds of complex insurance packages, it is highly customized and it is possible that the project company might not be able to understand the entire insurance requirements that may actually satisfy the lenders. So, in most circumstances an insurance broker is engaged who will help the project company in putting together a very effective insurance package. So, the insurance broker will have familiarity with the sector of the project company. For example, the insurance broker might actually have a lot of experience in terms of developing insurance package in identifying insurance needs for, let us say, the power plants, or it could be for ports and so on. So, because of his experience, he will be able to put together a very effective insurance package. Or second, the insurance broker would have familiarity in the region in which the project company is located. For example, the insurance broker would be familiar with the Indian market and therefore, he will be in a position to identify what are the different forms of insurance that is needed in the Indian context. Now, the project company or the promoters might not have the kind of insight that an insurance broker would have. So, therefore, it is always preferable to actually engage the services of an insurance broker in the case of project finance structures that we have been dealing in this course. So, the next thing I want to talk about is so, the next thing I want to talk about is what are the different types of insurance that we normally will have to have in place. So, for example, we talked about life cycle of the project consisting of two broad phases, the construction phase and the operation phase. So, we will try and look at what is the kind of insurance that we need in the construction phase, what is the kind of insurance that we need in the operation phase. Let us first talk about the construction phase. The most prominent insurance that is needed in the construction phase, it is basically construction all risk, or it is also called as a construction and erection all risks. So, this is an insurance policy which actually would cover the physical loss of damage to work. Say for example, it could be heavy rains, it could be earthquake, it could be fire, or it could be because of any of this, or it could be an accident that can result in damage to the works during the construction phase. So, the insurance policy will cover this kind of risk, and then that could be material and equipment at the site. So, materials could get stolen, materials could get damaged. For example, there is cement, and if the cement is actually exposed to water and rain, it can actually get damaged. So, whenever there is such damages, then this insurance policy will cover all the risks. It also covers the risk and damage caused by defective design. So, for example, if there is a design which is defective and that leads to further damage to the construction, the insurance policy also covers. It also covers workmanship. For example, if the employee does not do a proper job and it not because of the fault of the design, but is it the fault of workmanship involved, then the damages involved is also covered under the construction and erection all risks. So, everything pertaining to the construction and erection at the site is covered by this policy. The second policy that it should be in place is what is called as your marine cargo. This basically covers the physical loss or damage to equipment in the course of transportation. So, for example, we installing a power plant and it needs transportation of turbine to the power generation site. So, during the transportation, if there is any physical loss or damage, it actually covers, this insurance policy covers the loss that occurs during the transportation to the project site or prior to delivery. And then we have what is called as a delay in startup. Okay. So, a project company signs a contract, let us say it could be a power purchase agreement or it could be any other contract, which ensures that the project will be up and running at a particular date, and if there is a delay, so there will have to be some penalties that will have to be paid. Okay. Now, if there is a delay or damage because of construction or because of equipment not arriving in time and so on, then the startup will be delayed. Right. So, in which case the project company will have to pay some damages and penalties to the power purchaser. Okay. So, this delay in startup insurance will help to compensate for the additional costs, or it could compensate for the loss of profit that can result from delay in operations, either because of problems in construction or either because of equipment not coming and so on and so forth. Right. So, in a sense it compensates the construction and erection all risk policy. The construction and erection all risk policy does not really compensate for generally does not compensate for the delay, it compensates for the loss of material. So, if there is a material that has been lost, that policy will ensure that that is compensated. If there is damage to the structure, then the additional costs that would be incurred to bring the structure back in place will be provided, but it does not compensate for the delay in startup, the delay that can result in loss of revenues and profits, result in additional costs such as penalties and damages. It does not compensate for the interest payments on debt and so on and so forth. Right. So, we need to really have insurance insurance framework that is actually complementary and manages all the risks, and these are the three main insurance policies that we normally see during the construction phase. I mean, this is not an exhaustive list. The exhaustive list is maybe very long and it may be too technical, and so therefore, I am just giving you an indication of the main policies that we actually see in the construction phase. The next we look at the insurance policies in the operation phase. The main policy that we commonly see during the operation is called as the all risk policy. Okay. So, this covers the project against physical damage. So, the project is in operations and any physical damage can actually impact the functioning of the plant. So, therefore, we actually have a policy which actually covers for all this risk. Normally, this policy provides the replacement cost of the project or the equipment. Okay. So, the insurance under the all risk policy can be again having many categories. It could be machinery insurance, it could be property insurance and so on and so forth. The second most common insurance policy that is seen in the operations phase, and in fact, it is also seen in the construction phase, is a third party liability. Okay. So, third party liability insurance covers all those involved with the project company against third party claims. So, for example, if the claim arises because of an act of an employee, then if that claim has to be met, then the third party liability is the insurance policy will provide will address these kinds of claims that arises. So, this is a third party liability. Then we have the business interruption. Okay. So, business interruption is equivalent to that of the delay in startup insurance that we talked about in the construction phase. It should cover losses. For example, it could actually cover interest on loans. It should actually cover penalties that might have to be paid for contractual failures. It will actually have to cover for fixed operating costs, etc. during the period of interruption. Remember, whenever there is a physical damage, there is an interruption in business operations. There is an interruption in the operations of the project company, and the all risk that we talked about will not compensate for these interruptions. The all risk will actually provide the replacement cost of the equipment or the cost that is actually incurred to develop the project and bring it back to operating conditions. But at the same time, because of these interruptions, the project company will incur some kind of damages, and the business interruption insurance with the insurance policy that will help to meet the claims that arises due to such interruptions. Okay. Then we also have a force majeure insurance, which actually covers debt service if the project cannot operate. So, force majeure, as we have seen earlier, is an act of God. It could be war, it could be strikes, it could be rains, it could be natural disasters like earthquake and so on. So, whenever the project cannot operate because of such force majeure reasons, the insurance policy will provide for debt service. So, I think in addition to contract, you should also be very familiar with insurance as a way of risk management, and whatever we have discussed as insurance in construction and operation, they just give you a highlight. This just give you an indication of the different forms of insurance that we have commonly seen. Now, ultimately you may also come back and tell me that insurance is also a type of contract. Yes, but then insurance is a contract that we actually write with a specific financial institution, with an insurance service provider. They do not supply or they do not consume any of the outcomes from the project. So, if you have a fuel supply agreement, we are writing a contract with the fuel supplier. So, if you are having a power purchase agreement, we are writing the contract with the power purchaser. But in the case of an insurance, insurance provider do not supply or do not consume any of the outcomes from the project, right. So, therefore, in a sense, though it is a contract, it is different from some of the other contractual agreements that we talked about. Okay, so when we talk about project specific risk, the final risk that we are yet to discuss is operating risk. Okay. We have discussed all the other major forms of project specific risk in the previous lectures. So, we will spend some time in this lecture to understand the operating risk. So, operating risk can be broadly under the following categories. It could be technology risk, it could be general operation of the project, it could be operating cost overruns, it could be availability, it could be maintenance, it could be performance degradation, and so on and so forth. So, essentially if you look at operating risk, after the construction is complete and after the date of commercial operations, the risks that the project faces is called as your operating risk. Let us look at some of the main forms of operating risk that I have listed one by one. So, technology risk arises whenever there is a new technology that is being put in place. So, for example, if there is no prior strong history of operations of a particular equipment, and it leads to certain level of technology risk, because we do not know how the technology is going to perform. Is it going to perform as per expectation and so on. Let us say in the case of a power plant, if the turbine is an entirely new design and we are not very sure how the turbine is going to be performing in the future, right. So, the initial test results might be acceptable, but is it really going to perform as per expectation. So, that is a technology risk. Okay. So, the lender sometimes might not be very comfortable in investing in an entirely new technology, and whenever we are talking about a new technology, they will talk about having a lower degree of debt funding, or they will request for additional risk mitigation mechanisms such as guarantee from the equipment supplier and so on and so forth. The next is your general operations of the project. the project will have to be operated in a certain degree of efficiency, the maintenance will have to be done properly and so on. So, if there are any problems in regular maintenance, or if the operations are not being done properly as per the instructions, then it can actually affect the operations of the project. For example, the plant might not be functioning at proper efficiency, and this can actually result in higher degree of fuel consumption, or it can actually result in higher amount of wear and tear. This can actually result in increase in maintenance expenses and so on and so forth. So, the operations of the project should be done appropriately, and this is a risk. If it is not done appropriately, it is going to affect the revenues, it might also affect the costs. The third risk factor is operating cost overruns. So, we have actually estimated for certain level of operating cost, there is a possibility that it could be a overrun. So, whenever there is an overrun, because of the fact that we have actually signed up for a particular level of tariff, and any increase in operating cost overruns might actually affect your profits. Now, operating cost overruns can also reduce the coverage ratios, and whenever such coverage ratios are reduced, it can actually be of concern to the lender. So, that is another type of operating risk. And then the fourth is your availability. So, we talked about even though there is an offtake contract, let us say we have a take or pay contract, unless until the plant or the facility is available, it will not be eligible for any tariffs, any charges. So, therefore, the plant has to be available, and non-availability of the facility is one of the big operating risk. Then you talk about maintenance. The plant will have to be functioning for a certain duration of time throughout the year. So, if the maintenance is about, let us say 5 to 10 days in a year, for the remaining part of the time the plant will have to be functioning. So, the maintenance is again an important factor, right. Are we able to stick to the planned maintenance, or is the maintenance shutdowns is going to actually be higher? So, that is the level of risk that we are talking about. Then the performance degradation, initially we estimated a certain level of performance, the plant will actually have a heat rate of so on and so forth, the plant will have an efficiency of 70%, 80% and so on. Now, if this performance degrades over a period of time, it actually is also going to affect the project. So, if the efficiency reduces, then it might actually result in higher level of fuel consumption, and higher level of fuel consumption means a higher operating cost, and it will also lead to lower profits, and it will also lead to lower coverage levels, so on. So, essentially if you really look at it, operating risk can actually have two impact. One is at the top line impact, where it can actually result in reduction in revenues, or it can actually result in an increase in costs. And there are some of the risks which can actually lead to both reduction in revenues as well as increase in costs. Some can actually result only in increase in costs, but nevertheless it can actually put together lead to reduction in profits and also lead to reduction in coverage ratios for debtors. So, how do we actually minimize the operating risk? How do we actually mitigate the operating risk? So, the common way of mitigating the operating risk is by signing an operations and maintenance contract. So, like we actually sign several types of contracts to mitigate other forms of risk. To mitigate the operating and maintenance risk, we also have an O&M contract. Okay. So, the O&M contract helps to ensure that the O&M costs stay within the budget and projects operates as projected. So, if the budgeted expenses was let us say 2% of revenues, an O&M contract will ensure that there is a contractor who will ensure that it stays within the budgeted budgeted limit, and the project will operate as projected. Now, sometimes both of them can be done by single contractor, sometimes it could be split. Let us say for example, when both operation and maintenance are two different activities, then one may tend to split and have it as two separate contracts. So, for example, in the case of a toll road, toll collection is a very specific activity. So, therefore, toll collection can be a separate kind of a operation contract, and maintenance of the roads such that it is of a required quality and so on, it can be another specialized activity. So, therefore, there can be a separate maintenance contract for that. So, there are instances where the operations and maintenance contracts may be split. In many instances, operation maintenance responsibility is with the project company. So, let us say for example, we have BAAL. BAAL is actually responsible for operations and maintenance of the Bangalore International Airport, right. And one of the project sponsors can actually take the responsibility of operating and maintaining the airport. So, today you have the airport company is a project company, and then one of the O&M partners is also a project sponsor, is an actually shareholder of the project company. So, we have instances where the O&M contractors are important part of the project company. The contractors are paid a fixed or a cost plus basis. So, it is again depends on what kind of project we are talking about, and if the project operates below agreed levels. So, if the project does not function at a particular level of efficiency, or if the project is not able to offer certain level of quality, then under the O&M contract there are penalties. Okay. But O&M contractors normally do not take responsibility for all of it. Sometimes you have major equipments, you might have boilers, you might have turbines and so on. So, whenever we have these kinds of major equipment, the maintenance contracts are usually done by the equipment suppliers themselves, because it is very important that these large equipments are maintained appropriately, and if it is not maintained appropriately, then the efficiency can actually be reduced. Now, if the equipment does not perform as per expectation, then the equipment supplier can always put the blame on the O&M contractor, saying that these machines have not been operated properly, these machines have not been maintained properly and so on, right. So, therefore, to avoid those kinds of controversies, the responsibility for maintaining all these equipments is actually the responsibility of the equipment supplier. Okay. So, this will kind of ensure that the O&M contractors do not have the responsibility for any reduction in performance of these equipments. Okay, with this we have actually completed our discussion on project specific risk. So, the next category of risk that we will discuss is called as your market risk. So, remember when we talked about classifying risk into three categories, we classified them as project specific risk, market risk and country or political risk. So, we are now in the second component of the overall three levels of risk categorization. Right. So, if you look at market risk, how are they different from project specific risk? Okay. So, market risk are those that is going to be affecting the entire economy as a whole and not to any specific project. So, it could be economy level indicators. So, for example, the three kinds of market risks are, we have inflation, we have interest rate risk and we have exchange rate risk. So, whenever there are any changes in any of this, it is actually going to impact the entire country as a whole, it is going to impact the entire sector as a whole, and it is not specific to any particular project or any particular sponsor, right. So, therefore, these are called as market risk. So, how do we actually handle this market risk? Okay. So, let us look at each of these three common forms of market risk one by one. First is inflation. So, what is inflation? A general increase in price trends is called by inflation. So, for example, today if we buy a kilogram of rice for 25 and tomorrow it becomes 30, then part of it is increase is attributed to inflation. So, the general price increase in goods and services is basically due to inflation. Okay. Now, inflation cannot always be considered to be a harmful factor. It can either be a risk or it can be a benefit to the project company depending on its timing or occurrence. So, therefore, it is not right to look at inflation as a major risk, and it is always going to affect the project in a very wrongful way. Sometimes it can actually be beneficial as well depending on how the contracts are being structured, right. See, for example, if the revenues continue to increase with inflation, but at the same time if the costs are fixed, because we actually have agreements that will ensure a fixed cost, then it can actually lead to a benefit for the project, right. But normally how is inflation handled in infrastructure projects? There is a separate there is appropriate indexation against inflation in project agreements. So, for example, we have several agreements that supply goods to the product, and then we have several agreements that actually are offtake agreements, right. In both these cases they are appropriately indexed against inflation. So, if the inflation increases so much, the tariffs will also increase so much, and if the inflation increases so much, the cost of fuel also will increase so much. So, having appropriate indexation for both outputs as well as inputs helps to reduce the mismatch between costs and revenues. So, if the revenues increase, the costs also increase, or vice versa. Okay. So, the inflation is the impact of inflation is not really very large. If we actually have cost of debt which is fixed, then inflation can even lead to the project company being better off. See, for example, the revenues are increasing as per inflation, then in the cost there are some costs which are indexed to inflation and they continue to increase, but then debt service, particularly the interest cost, if it is not linked to inflation or if it is not linked to any other parameters and it continues to remain constant, then a portion of the cost factor remains constant. So, therefore, an increase in inflation is not going to lead to an all round increase in all the costs, and therefore, the profits are going to be higher with increase in inflation. Another way to manage inflation is also to use specific financing schemes that are linked to inflation. We do not really have these kinds of schemes in India, but in countries such as the UK there is something called as inflation linked bonds. Okay. So, the rate of interest is linked to the inflation levels in the economy, and we can use financing of these kinds to actually mitigate the risk of inflation. The next form of risk is your interest rate risk. So, we have seen earlier the project finance loans are usually for a long term, and whenever we actually have a long term loan, it is not possible to actually have a fixed interest rate, because if you really look at it, as the economy changes, the interest rate might also vary, and therefore, in many cases the interest rates are benchmarked to a particular rate. So, and whenever there is a change in the benchmark rates, the interest rates of the loans also change. The most common benchmark is your London interbank offer rate, LIBOR. There are other benchmark offer rates as well. So, when there is a fluctuation in interest rate, what happens? If the interest rate becomes higher, then it leads to lower project cash flow, and it also leads to a reduction in cover ratios. So, for example, lenders who actually expect certain level of cover ratios, because of an increase in interest rate, the cover ratios will reduce, because the EBIT levels will remain as it was before, but the interest component will increase. So, therefore, the interest coverage ratio might actually reduce. Okay. So, this is something that might not be acceptable for the lenders, because the lenders would not want the project to actually get exposed to interest rate risk, and therefore, the lenders will expect the project company to provide some kind of coverage to mitigate this interest rate risk. So, what do we actually do? What do the project companies do to actually mitigate the interest rate risk? So, the two common strategies is to use an interest rate swap. So, today there are banks that are willing to actually swap floating rate loan with a fixed rate loan. So, the bank will exchange a floating rate interest rate with a fixed rate interest rate. Okay. So, this actually results in technically a synthetic fixed rate for the project company. Okay. So, interest rate swaps are one mechanism by which we try to manage the interest rate risk. The other instrument that is used to manage the interest rate risk are called your interest rate caps or collar arrangements. So, how does an interest rate cap work? Let us say for example, a cap is fixed, let us say for example 10%, right. So, if the rate of interest is below 10%, then the project company pays the floating rate of interest. Okay. And the moment the interest rate increases more than 10%, the interest rate is capped at 10%. The difference is actually paid by the bank, which has actually written this interest rate cap contract. Okay. The collar arrangement is different from a cap arrangement in the sense that there is also a floor. So, for example, we have a floor which could be 7%. Right. As long as the floating interest rate is between 7 and 10%, then the project company will pay the actual rate of interest. But if the interest rate falls down to less than 7%, then the project company will actually pay the difference in the actual interest rate and 7% as a compensation to the bank that has actually provided the collar arrangement. By the same token, if the floating rate interest exceeds 10%, then the project company will actually pay an interest rate of only 10%, and the difference will actually be paid by the bank that has actually provided the collar arrangement. So, these are all actually risk mitigation schemes to manage the interest rate risk. So, when we actually have a band, then we know clearly that the interest rate for the project company is not going to go beyond a certain level, but having a floor also ensures that the project company does not actually make profit much from a fall in the interest rates. The next risk is your exchange rate risk. Okay. What is an exchange rate risk? This risk occurs when there is a mismatch in the currency. So, currency mismatch can be in both the construction phase and the operation phase. Let us say for example, in the construction phase, the source of funds is at a different currency and the expenses are at a different currency, then there is a currency mismatch, right. For example, if the lenders are providing a loans in dollars, but if the expense is in rupees, then there is a currency mismatch. Right. And in the operation phase as well, there could be a currency mismatch. If the inflows are in a different currency and the outflows to investors are in a different currency, there is a currency mismatch. So, if you actually have a dollar loan and if it is a power generation facility, the tariffs and the revenues are going to be in rupees, but the loan will have to be repaid in dollars. So, there is the currency risk. So, whenever we have this kind of an exchange rate risk, like in the case of interest rate risk, lenders may not be willing to accept the project to bear the exchange rate risk, because if the project is unable to bear the exchange rate risk, then the lenders are the people who are going to be affected. So, the lenders would to a certain extent would expect the project company to mitigate all this exchange rate risk. So, how do we actually mitigate the exchange rate risk? Okay. The most common way is to use some kind of a hedging instrument. Let us say for example, you can actually have currency swaps, like we actually have interest rate swaps, you can actually have currency swaps. Another common form of mitigating is your using forward contracts. So, what happens in a forward contract? In a forward contract, we fix in advance the exchange rate between the different currencies. So, even though there is a change in the currency rates, it is actually mitigated. So, the currency rates changes would not actually affect the project company. The third is actually try and ensure that there is a currency matching between the inflows and the outflows. So, if you are talking about a project which is actually earning revenues in rupees, but the outflows are in dollars, can we actually ensure that the revenues are either in dollars or the outflows in terms of debt servicing is in terms of rupees. So, by trying and ensuring currency matching, we can also mitigate your exchange rate risk. So, whatever kind of hedging mechanism that we can think of, whenever there is what is called as a catastrophic devaluation. See, normal currency movements, normal market currency movements, these kinds of contracts will be able to manage, but if there is a very rapid devaluation because of some government actions, then it is really difficult to go, it is going to be really difficult by any of the hedging mechanisms. So, that has to be understood. So, sometimes the currency can be devalued by 10%, by 20% overnight. So, under those circumstances any of the hedging mechanisms might actually fail. Okay, before we end this lecture, we will come to the questions for this session. We have two questions. The first question is, in risk management and contracting, you will often encounter a phase called a direct agreement. Okay. So, what is this direct agreement and what is the purpose of having this direct agreement? So, that is the first question. The second question is, we talked about a swap arrangement where we actually swap floating interest rate with a fixed interest rate. So, in a swap arrangement, neither side is lending the other any money, there is no money transaction. So, is there any credit risk associated in such a transaction? So, we will discuss this in the next lecture.